All right, let's talk about something you've probably seen 1,000 times if you've ever been on TradingView. You see these strategies promising these just incredible, almost perfect win rates. But what if I told you the pros, the people who do this for a living, they don't even chase win rates? Today, we're going to pull back the curtain and really look at what makes a professional trading system work, getting past all the hype and into the actual numbers. So, let's just start with a crazy thought. It sounds totally backwards, right? A strategy that wins almost every single time? I mean, that should be the holy grail. But this, right here, is the biggest trap that so many traders fall into. Because the real danger isn't in the trades you lose. It's all about how you lose them. And this quote just nails it. It's called the steamroller analogy. Just picture this. You're picking up penny-ins off the ground right in front of a giant steamroller. You do it successfully, 99 times, picking up small win after small win. But that one time you trip, that one time you're not fast enough, the steamroller gets you, and it doesn't just take back the pennies, it wipes out everything. That's the hidden risk of chasing a perfect record. So that brings us right to our first big topic, the high win rate trap. It's this really tempting idea that winning more often is the only thing that matters. But like we just saw, a super high win rate can actually be a smokescreen hiding a massive account-ending risk that's just waiting to happen. Okay, so if win rate isn't the main goal, what do the pros look at? They look at this, mathematical expectation. And the best part is, it's not some crazy complex formula, it's just simple, powerful logic. It's a balance. It's not just about how often you win, it's about how much you win when you're right versus how much you lose when you're wrong. You could have a strategy that only wins 50% of the time, but if your wins are, say, 3 times bigger than your losses, that strategy could be incredibly profitable. That's the real game. Which, of course, leads us to our next section. If win rate isn't the be-all and end-all, what is? Let's dive into the metrics that the pros actually use to see if a strategy is healthy and if it's built to last. These are the numbers that really separate the solid systems from the ones that are just ticking time bombs. Take a look at this. Yeah, a win rate over 60% is great. We're not saying it isn't. But that's just the starting line. Look at something like profit factor. You want that above 2. That basically means for every single dollar you put at risk, you're making more than $2 back. And the Sortino ratio? That one's really cool. It only measures your returns against the bad kind of volatility, the downside risk. It tells you how smooth your equity curve is going to be. See? These metrics tell a much deeper story. And this really forces you to reframe the whole objective of trading. Losing isn't failing. It's just a business expense. It's the cost you pay for information in a market that's filled with uncertainty. The goal is never perfection. It's just positive expectancy. It's about playing a numbers game where over the long run, the math is stacked in your favor. All right, enough theory. Let's see how all these ideas actually look in the real world. We're going to peek under the hood of 3 really interesting elite-level strategies you might find out there. They all take different paths, but you'll see they're all built on the same solid quantitative foundation. So first up is a strategy that's, frankly, brilliant. It's not just one static system. Think of it more like a toolbox. Its core genius is that it knows no single tool works for every job. The market can be trending up, trending down, or just chopping sideways. And this system literally changes its entire personality to match whatever the market is doing right now. And yes, it can hit a mind-blowing 87% win rate. But look closely at the wording here. When the system correctly identifies a trending market. That's the secret sauce. This thing isn't just firing off signals left and right. That high win rate is the end result of an extremely picky filtering process. It only takes a trade when it decides the conditions are practically perfect. So how does it do it? Well, first it diagnoses the market's current regime. Is it a strong bull trend or just a messy, volatile range? Then it uses confirmation tools like ADX and volume to make sure its diagnosis is correct. Only then, once it's sure, does it pick the right tool for the job, ensuring it's always trading with the bigger picture, with what traders call a tailwind. Okay, next up, let's look at something completely different, a strategy for the gold market. This one isn't about a bunch of complex indicators. It's more about reading the story of the chart. It's built on the idea that the big banks and institutions, they leave footprints in the market. And if you know what to look for, you can trade right alongside them. It follows this classic 3-step pattern: accumulation, manipulation, and distribution. First, accumulation. That's when the price is just coiling, trading sideways in a tight box.
Then comes manipulation. This is the key step. Price makes a sudden, sharp move outside that box. It's a fake out, a stop hunt designed to trap traders. And finally, distribution. Price violently reverses and snaps back in the other direction. This strategy's whole goal is to get in right after that manipulation move.
Now for our third and final example, we are going to the cutting edge. We're talking about a machine learning system. You know how financial markets can be just chaotic and noisy with these crazy, unpredictable price spikes? Well, this strategy is specifically designed to see right through all that noise.
It uses a really advanced mathematical idea called Lorentzian distance. Now that sounds intense, but here's a simple way to think about it. Most computer models get totally confused by a single huge price spike. It throws off all their calculations. Lorentzian distance is a way of looking at patterns that kind of compresses the impact of those extreme outliers. It lets the algorithm ignore the crazy noise and focus on the real underlying pattern. It's just a smarter way to see the market.
Okay, so we've looked at an adaptive system, we've looked at structural analysis, and we've looked at machine learning. Pretty different approaches, right? But what's the one thing they all have in common? What is the real ultimate edge that ties all of this together?
I mean, the level of tech we're talking about here is just incredible. On one hand, you've got machine learning sifting through mountains of data. On the other, you have advanced regression models that can spot a trend with almost zero lag. The tools are getting more and more powerful. But here's the twist. The tools themselves, they're not the edge.
And this is the most important takeaway of all. The ultimate edge isn't in the code. It's not in the algorithm. It's in the mind of the person clicking the mouse. All of these incredible systems are worthless, or honestly even dangerous, without a disciplined trader who puts risk management before anything else. It all comes down to risk-first thinking. And that brings us right back to where we started. This quote just says it all, doesn't it? The real path to making it in this game isn't about trying to never lose. It's about accepting small, controlled losses as a necessary business expense. They're the price you pay for information. That's how a professional thinks. So, as we wrap up, we're left with this thought. The tools to find and build a real statistical edge, from adaptive algorithms to machine learning, they're more accessible today than they have ever been. You have the tools. The only question left is, do you have the discipline to use them the right way? Thanks for tuning in.